Hi everyone, thank you for being on our webinar this evening. We're going to be talking a little bit about how the wealthy use self-directed retirement accounts to protect themselves in market downturns, as we've seen recently and at the end of the year last year, and what all the big outlets are predicting today. We're excited to have Brittany Piquel from Next Generation. They are a self-directed IRA custodian that can help you open a self-directed account that is different from your Fidelity or your Charles Schwab, where you can invest in alternatives like what we do here with real estate, precious metals, mortgage notes. And I wanted to invite Brittany on to kind of cover some of the misconceptions. How are you doing this evening, Brittany?
Great. How are you, Josh?
Doing well, doing well. You know, a lot of people think this is a brand new strategy. How long have self-directed IRAs been around?
So the ability to self-direct an IRA has actually been available since the inception of the IRA itself in 1974. I think it just hasn't been a widely marketed concept, and there hasn't been a lot of education provided, especially not by your large banks and brokerage firms, because they don't specialize in holding these sorts of assets. So they're going to be focused on the asset types that they do allow, which would be your typical stocks, bonds, and mutual funds.
No, and that makes sense, and it's what they offer. So why would they offer something that takes money away from them or their financial advisors and broker dealers? And that's where I hear a common misconception where a lot of clients will say, you know, they have a self-directed account, but it's a Fidelity self-directed account. Maybe you could explain a little bit about, you know, that confusion and why people will think they have a self-directed account, but really they don't. Like it's only a Fidelity version of it.
That's a good point. So the term self-directed has been used to mean multiple things, and it's important to understand what a truly fully self-directed retirement account is. Essentially, when Fidelity or other custodians like Fidelity indicate that an account is self-directed, they're just referring to the account holder having more flexibility in choosing their investments. But again, when you think about tying it back to the allowable investments in that account, they're still restricted to, generally speaking, restricted to publicly traded assets and securities. So the difference between a truly self-directed retirement account is the ability to choose all your own investments, and also with that, having a larger menu to choose from, which includes non-publicly traded alternative assets. So you truly have the ability to have more control over your return on investment and the investment options available within an actual self-directed IRA. So if you go to Fidelity and you say, you know, per Josh's earlier comment, I want to invest in real estate you told me I have a self-directed IRA. Well, yes, it's self-directed, but not in that sense. So they're not going to generally let you hold real estate in that account. And that's where you need to really work with a self-directed custodian in order to establish that sort of account, and one that is also familiar with the IRS regulations that surround how investments can be made when you're talking about alternatives. So it's important to be sure that you're using the proper resources and that you are educated on the differences and then the implications of those differences as well.
Absolutely. Education is key, and I appreciate you being on to share your knowledge and expertise with all the investors we have here who are hearing about this potentially for the first time. You know, and follow-up question on that, a lot of times, you know, it's in the best interest of your current custodian to keep you invested with them. So, you know, I would be very, very direct with them. You know, ask them, can I buy real estate with this? Can I invest in precious metals with this? Because those are obviously very allowable investments, as we know, with Next Generation, and, you know, real estate being a very popular one where you can own real estate. Would love to hear, you know, what some of the uncommon ones you've seen working there at Next Generation Trust that are out of the ordinary, because there's really a very small list of what you can't invest in, right?
Right, exactly. So the only things technically defined by the Internal Revenue Code that you can invest in are life insurance and collectibles or antiques. So you can't hold those things in an IRA. But outside of that, you can get pretty creative. So of course, real estate is a big one. precious metals and private equity are common. But even within some of those categories, we've seen people invest in, coffee farms in foreign countries, actually racehorses, cattle, raw farmland. We have a client that invested in lawsuit funding. So I think we also had one that used their self-directed IRA to purchase licenses for season tickets to a football, one of the NFL teams for football games. So if you kind of let the boundaries of your mind expand a little bit outside of what you're used to, you can do some pretty cool and creative things. Of course, keeping within the regulations and the limits, but you do have a lot more control.
Absolutely, absolutely. Well, excellent, Brittany. Brittany will be kind enough to be on at the end, and we'll answer some more questions directly about next generation trust and our strategy. I'm going to switch it over to diving into a little bit more about what we do, and then please stay on at the end. If you have any questions, we'll be available to go over them with you. All right, so thanks, Brittany. For those who aren't familiar, our company is SD IRA Wealth. We're an investment company that offers a full-service solution to help Americans with the retirement crisis, and the vehicle we mainly use is real estate. We have over 30 years of experience in real estate. We've done over $400 million in residential real estate and over 5,000 transactions, and we've done this across 14 states and over 40 cities throughout the country. My name is Josh Gilmore. I'm a real estate investor and I'm one of the vice presidents here. I've been investing in real estate myself for a number of years. I own 8 different properties in different cities throughout the country, and I'm really passionate about helping individuals get away from the stress of the volatility in the stock market and into something more tangible. And the best part about real estate is it's a great vehicle to help with the retirement crisis we're all facing. Part of that is the volatility in the stock market, and we'll talk about that. But part of it, and that what's important to understand, is what's going on with our benefits, our social safety nets. Social Security is really about to buckle, and this study from Business Insider says that by 2035, you'll receive at least 21% less from Social Security than individuals do today, which is huge. That makes a giant difference in your retirement. Losing 21% of that income can be the difference between paying your bills or not being able to. Now, another piece that's unfortunately gone away is pension plans. Back in 1979, about 30% of companies offered pension plans, and today that's down below to about 3%. And what has increased is your defined contribution plan, something like a 401k, which you potentially get a match with, but obviously that's tied to the stock market and has volatility. So we're going to discuss that as well. The unfortunate reality of these factors is 3 times as many people are declaring bankruptcy in retirement today as they did in 1991. So this is a New York Times study that came out last year, and it's just all very unfortunate. And then to put a little bit more salt in the wound today, we see a lot of volatility in the stock market. Here's the performance over the last year, and a lot of us remember this, and we're lucky it bounced back, but it's starting that trend to drop off again. As of this week, beginning of this week, the Dow Jones was down 600 points. And I have a lot of newer clients who came to us because they, at this time of the year, right around the end of last year, that made a huge dent in their retirement and can set you back a few years in addition to putting yourself in an awful position. So what we like to focus on is a solution to this problem and why wealthy individuals aren't worried about it. It's not just that they have a lot of money, it's that they've created what is called freedom level wealth, which freedom level wealth, simply put, is having enough income to cover your expenses in retirement. So regardless of what the stock market does, whether it's up, down, or sideways, you have passive income coming in that you can live off of. And one important piece to take into account with that is the rising cost of healthcare and the fact that the average couple will need at least $280,000 for retirement, and that's retiring at 65, looking at no additional dental coverage, and it could potentially be higher, and that's obviously in addition to Medicare and Medicaid. So you need to factor in the cost of healthcare, That's how we calculate freedom level wealth. And I would suggest you take out your pen and paper and even do a rough drawing. You know, if you're retiring at 65, you're looking at about $1,000 a month factored in for healthcare, your monthly expenses, and then your monthly entertainment, which is kind of your buffer. You know, if there's anything extra you need to spend from, that comes from there, whether you want to visit the grandkids, or for me personally, it's about having funds set aside to travel a lot when I'm looking to retire. So you'll see an example here of calculating out that freedom level wealth. I'll do mine as well with you, just so we can take a look. You know, my plan is to retire at 55, so we're going to be looking at about $2,000 a month for healthcare. Monthly expenses with the mortgage paid off is going to be about $5,000. And then for the fun, I want to look at traveling a lot, so we're going to put in $4,000 for that. And we're looking at a total of $11,000 is the number I need to get to in order to retire comfortably without having the fear of running out of money in retirement. Now, I won't talk too much about this since we covered it with Brittany, and we'll open it up for some questions, but the secret to getting there is in part a self-directed retirement account. This allows you to invest like a Mitt Romney, someone who has over $20 million in a Roth IRA because he self-directed it and invested in alternatives outside of the brick and mortar stock bond mutual funds. And it is a very, like we discussed, common misconception in the blind leading the blind, where only 4% of IRAs out there are truly self-directed. Now, you may have, like we discussed, a Fidelity self-directed account where you can pick your own stocks, but that doesn't allow you to invest outside of the traditional investments. And this is why 75% of retirees will not reach financial freedom on their current strategy, their current path. So we like to follow the wealthy who, like a Mark Cuban, you know, last August had a lot of due diligence, and his advisors told him to take his money out of the market. He saved himself from that huge drop that affected so many of us by being decisive and switching investments and making decisions. Now, what we're discussing and what we're passionate about is what diversifying through owning income-producing real estate. Not real estate for the ups and downs, but real estate for the passive income you can make on a monthly basis. And we follow, you know, as I mentioned, we follow a lot of the wealthy folks and what they do. And over the last 2 centuries, 90% of the world's millionaires were created through real estate. And in today's market, there is such a demand for rental real estate that Wall Street's big landlords are building new construction houses all throughout the country. Higher home prices are actually improving the outlook for buy and hold real estate because it's making it harder for people to buy their own homes. And real estate in a bear market is really truly a safe haven. It has low correlation with public markets, and it's uniquely positioned to weather downturns because no matter whether the economy is up, down, or sideways, everyone always needs a roof over their head. That is something that will never go out of style. Now, the secret number 3, and this is a really important one to write down, is to do your homework. You know, wealthy investors don't just invest in real estate, cross their fingers, have a hard time sleeping at night, and get worried about what could go wrong. No, they've done their homework. They understand the risks in real estate compared to the risks of other investments like stock, and they're more comfortable with those risks. And that's where, you know, our 30 years of experience comes in handy to find specific real estate markets that are incredible for real estate investing throughout the country. We love emerging markets, college towns, and urban markets, and we do 18 to 24 months of due diligence before we find a market we want to invest in and go into. And it's important to understand real estate market cycles. Key is buying at the right time and selling at the right time. And you want to look for the markets with the maximum opportunity and the minimum risk. You know, the markets that there's excitement and optimism and euphoria because people have been there and they've made a lot of money, those actually have the minimum opportunity and the maximum risk because they've gained the most value recently. So we follow another one of our mentors who is Warren Buffett. You know, be aggressive when others are fearful. We in doing our research, you look at key indicators like building permits, cost of living, average rents. Vacancy rates is a huge one. We don't invest in markets with more than 5% vacancy. Inflation rates, making sure that the cost of living is low enough to continue to see population growth. And through doing research, in addition to finding the right area to invest in, we need to find the right team, the dream team management that's going to manage and take care of these properties. This is the team that's going to be on the ground, boots on the ground, taking care of the properties, working full commission the way we set it up to oversee the properties and keep tenants in there and keep that income coming in. So in order to find the right team, you've got to do a lot of due diligence. We want to interview a minimum of 3 separate managers in each market we do real estate investing in. We want to hear from their clients. We want to see their reviews, and we want to, above all else, make sure they're vetting tenants well. What does that mean? That means the people they're putting in your property or our property are good folks with great income. They have the money for the first month deposit as well as the first month's rent. They have references from landlords that get verified that say this tenant was a great tenant. And above all else, once they're in there, they follow up. They do regular inspections on the property. They check in on how the tenants are doing. They get new leases when a lease is about to expire to minimize downtime and switching out tenants. And having a great manager versus having a bad manager is really the difference between an investment going well or not going well. So there's a lot of homework and due diligence on our end that we always put in before we go forward with any projects. And secret number 4 is actually my personal favorite. It's utilizing leverage, banks' money, to your advantage as a real estate investor so you can generate a higher ROI and get to your freedom number faster. So utilizing leverage, there is a problem when we're talking IRAs specifically. That problem is you're not allowed to get conventional financing, conventional being the mortgage you get from a Bank of America, Wells Fargo, tied to your personal credit line. You have to use what's called non-recourse financing inside of an IRA. Now that's because with your IRA would technically be the owner of the investment property that we offer. So not you personally. I mean, you own your IRA, but in the eyes of the IRS, your IRA is a separate entity from you that you're not allowed to provide a service to. So that's part of the, Brittany touched lightly on the rules and regulations. When your retirement account buys an investment property, you can't fix it up, you can't provide a service to it. And giving a loan tied to your credit line, like the mortgage on your house, is prohibited by the IRS. So the only type of financing is what's called non-recourse financing, which to put simply is an asset-based loan. So these are lenders that are doing their due diligence and homework and what we call underwriting specifically on the property in question, not on you or your creditworthiness. So to get a non-recourse loan, it's got to be a great property in a great area with a great management team, and it has to be a very safe investment because the only collateral is the property, unlike the mortgage on your house where the bank took into account your credit, your income, and you being personally liable for that loan. So for me as an investor and for our clients as well, it's a huge peace of mind to know that we as a company have actually brought in a third-party lender who's gone through the process of underwriting the property in question, approved the loan, so you as an investor or any other investor out there who's buying this property has a bank that's done their homework and approved it. And 9 out of 10 deals we look at actually get denied for financing, and that's the final due diligence check before we move forward on a project, is we make sure there is financing there in place. Next question we'll get from investors is, why would I use non-recourse financing? Why wouldn't I just buy the property cash? Why would I want another mortgage, especially a mortgage in the IRA? Great questions and great concerns. When you utilize leverage strategically, which is what we do on purpose, not only does it give you peace of mind knowing you have a great asset, but you're generating a higher return in 3 separate ways. Higher cash return, higher appreciation, and it helps you hedge your risk. And we'll discuss those. Obviously, cash is the most important, but appreciation is part of the equation. Over time, home values increase. They're very correlated with inflation. And you think back 20, 30 years, any house pretty much anywhere is going to be worth a lot more than what it was previously. So let's take an example. This is going to be an example we use to show you the difference in cash versus leverage, where you're talking about a $150,000 portfolio. Now, you could buy one $150,000 house at the end, or three $150,000 houses where you're putting down roughly a third, $50,000, and each other house will have a $100,000 non-recourse loan. So you're able to buy three with the leverage for the same price as one all cash. Now let's say a year goes by and the market just stays steady at 2% value growth. Well, if you had the one house, 2% value growth is $3,000 in value growth and appreciation on your asset. Now, if you were to buy the three with the same $150,000 invested, you would get 3 times that growth because you own 3 assets. So that would be $9,000, or 3 times as fast appreciation with the leverage than without. You know, think back 20, 30 years in your market. If you were to buy one house, how much more money you would have made, and what if you were to buy 3 of those houses? You know, it's really night and day when you are able to utilize this leverage and really increase and triple your purchasing power. Another way this helps you do better as an investor is it helps you hedge your risk. If you buy one house, you're putting all your eggs into one basket. You have that one house. If it goes vacant, you're not making any money and you have expenses. Now, if you spread that risk out, you hedge your risk by buying 3 different properties, potentially in 3 different areas, so you get different economics. I own properties in 8 different markets, so I'm not relying on just Texas doing well. I also have Tennessee and Illinois and Nebraska, different areas with different economic factors to help generate a high return. So one of these being vacant for me doesn't affect the other 2, and I still have cash flow. I still have income. And now, obviously, the most important part of real estate for income buy and hold is the income you're making, the ROI from a cash-on-cash perspective, meaning what you invest and what you get back. So this is an example, same situation, $150,000 property. You pay all cash for it, so you invest the full $150,000, rent it at $1,300, no mortgage payment, property taxes $200, insurance $40, management $100, and maintenance $40. So at the end of the month, you're looking at generating $920 a month, or $11,040 at the end of the year. Now that is a 7.4% return. Not terrible, but not great either. Now if you're looking at the 3 properties on the right, that would be the same amount invested, $150,000. You've got a total of $300,000 in non-recourse financing, and you're buying $450,000 worth of real estate you own. So your account value shoots up when you're doing this and triples, and you're generating 3 times the rental income, $3,950. You do have a $1,650 mortgage payment. All the expenses are tripled since you own 3 of these properties. Yet at the end of the year, you end up with over $2,000 more in net cash flow, cash on cash that comes back to you or to your retirement account tax deferred, than the same amount invested on the same one property, because you're utilizing leverage. It's the ability, the debt service is incredible. And similar to the way you pay down your mortgage and you pay that off, each time you make a mortgage payment, a little bit more goes towards principal and a little bit less goes towards interest. A non-recourse mortgage works exactly the same way. So after 1 year of the tenants who are living there paying your mortgage for you, you've reduced the principal balance on that mortgage by $4,650. So you're looking at a 12% ROI without factoring in appreciation versus a 7.4% ROI. So I know which one I'm going with every time, and it's absolutely advantageous for you to do that as well. And for a lot of our clients, and this goes for myself, once a year I make a decision what to do with the cash flow I've built up in my account. You can utilize the extra cash flow to pay the mortgage down faster and debt service these assets to get them to being free and clear. So you buy these portfolio today and you have $300,000 worth of a mortgage. After the first year, if you put the cash flow plus the equity into it, it's down to 282, then 264, then 246, then 227. And you can really snowball this to pay these properties off. And what portfolio like this, we would structure this for someone who's looking to retire in, say, about 12 years, because in 12 years, Mr. Investor here will have those 3 homes fully paid off, free and clear, and he's generating $36,000 extra income per year, about $3,000 a month. That's versus buying just the one that would be doing 1/3. And once that mortgage payment is knocked off, that all is extra income for you. So we structure these portfolios customized to help you get to your freedom level wealth number. Now, put that in perspective, 12 years down the road, that $150,000 became $36,000 a year. That's over a 24% return on investment per year once those mortgages are knocked off. And you can structure this, we talk a lot of times with our clients about portfolios. How many properties do you need to get yourself to your freedom level wealth number? And for this example of $10,000 a month in passive income, you would need 10 of these properties, free and clear. Can be done over time. It doesn't all have to be done at once, and it's an incredible strategy where you can sleep a lot better at night, not having to worry about the volatility or pieces of the equation that are out of your control. I love real estate because it's real, it's tangible, and things can be fixed on it. You can't fix a stock market crash. You're stuck in it. So for the investors who want to be a little bit more passive with this type of investment and take out the headaches of having to do the research themselves on the markets, on the management, on finding and getting the approval for the loan, we have a passive strategy with our real estate opportunities where all of this is done for you. We do all the front end evaluation utilizing our experience. We do all the research on the management companies, and we even have an in-house team after you purchase with us that oversees the management and is a second set of eyes. We set up the financing, so that's pre-approved and in place, and there's no hoops for you to jump through, no application, and whether you buy it, the property with the financing, or I buy it, or another client buys it, our lenders don't care because they've done their homework and they're comfortable with the asset and the team managing it. And obviously, we are your partner. We don't go anywhere after the sale. We help a lot of investors do this for the first time, especially in an IRA. And we have all these pieces in place to make this a successful investment and beyond, because at the end of the day, we're looking to add on more over time, build out these portfolios, and help your friends and family get involved in this strategy as well. So we're very selective with who we work with, and we're very happy to have tremendous amount of testimonials and reviews from our current happy clients. Over 70% of our clients repurchase as well. So the plan isn't obviously just starting with one, it's adding on more over time as you're comfortable, getting involved in more markets and solving a problem, whether that's the retirement crisis, generating enough income, or true diversification from the stock market. Like I mentioned, we are very selective on who we work with. You want to understand more about your situation and if this would be a great fit for you. I can tell you the people who are the best fit are the people who want a totally passive experience. If you want to spend time and energy doing a rehab, if you want to go out and pick the color paint in the property and do your research on the specific area, and you want to interview property managers and understand all the basics and be in full control of everything, this strategy likely isn't the right fit for you. This is more about generating mailbox money where you have a monthly income check coming to you. You own the properties, but it's about taking out the headaches of real estate investing. So thank you so much for being on our presentation tonight. I'm going to jump over to answering some questions now with Brittany. Feel free to type them into the chat bar as well, and we'll go through your questions one by one, get everybody well educated and their questions answered. Good deal. So thank you everyone for being on tonight. Switching over, I see that we've got quite a few questions pre-submitted, as well as anyone who's typing them into the chat bar or the question bar below. We'll get to as many as we can here tonight. I want to start with some of the pre-submitted questions here. Good question for the process. What does the process look like when you're funding a deal with a self-directed IRA? So, it's very similar to, if you've bought your own primary residence or bought an investment property before, either or, where you do a purchase agreement to buy the property. The purchase agreement will be for your self-directed account to buy the property. Depending on the market, you're going to open and close escrow, or it'll just be escrow held by the title company. Earnest money, you set a close date, you close, you take ownership of the asset, and obviously, if you're using your IRA technically is taking ownership of the asset. Brittany, I've got a good question for you. What's the process for creating a self-directed IRA?
Sure, good question. The process begins with establishing a newly formed IRA. So as I mentioned earlier in the video, you have to work with a self-directed IRA custodian that's qualified to hold these types of accounts. So the first step in your process would be selecting one to work with. And you want to look for things like responsiveness, easy to get in touch with, good customer service, since you'll be working pretty closely with them on your investments. And then you would just simply complete an application with them in order to establish your new IRA. Once that IRA is set up, which should only take, a day or two for them to get established, you would then talk to them about funding your account. And there may be some questions about that later, so I'll hold off on talking about that for now. But essentially, you would just complete an application. As long as you have U.S. earned income and you have a tax ID number, you can have an IRA.
Excellent. Thanks, Brittany. How do I find a company I can trust that offers this type of IRA? Obviously, that's a great question. You want to do your due diligence. You can look at recommendations and reviews from previous clients. And I'll let Brittany speak a little bit more about that on her company's side.
Sure. When you're looking for a custodian, because obviously, yes, this is a sensitive topic because you're looking for an institution to hold your retirement funds, and you want one that can do a good job of safeguarding them. So custodians, as I mentioned, we are for self-directed IRAs, have to have certain, they need to be regulated by specific entities. And what makes us a custodian is that we're actually a trust company. So in order to be a trust company, we have obtained our trust charter, which requires a very rigorous process to obtain. And in doing so, you're basically regulated by, we're regulated by the Banking Commission of South Dakota, which is where we have our charter. Now, that doesn't restrict us from holding retirement accounts elsewhere. It's just that the state of South Dakota has laws very favorable to self-directed IRAs, so you'll find that many companies have their charters there. But that is the authority that regulates us. We're regularly audited. We have to provide lots of reporting back to them, obviously, related to business activity. And I would say you want to reach out to a company, establish a relationship with the person that you've spoken to a couple times maybe, that's provided education to you, because the role of custodian is not only to do record keeping and reporting on the account, but also to provide education to you and help guide you through the process of setting up your account, funding your account, and making an investment to ensure that it's a smooth process and that you are educated on IRS guidelines so that you're working within the rules and regulations.
Excellent. Thanks, Brittany. All right, let's see. Do we own a percentage of a property that we buy from SDIRA Wealth, or are they individual properties? So what's great about our strategy, one of the things our clients love is they get control because they get actual ownership of an individual asset. So we do the real estate in bulk. We'll build 50 new construction homes, bring in a lender so that non-recourse is pre-approved and you only have to put in a down payment. And you as an investor would be buying 1, 2, 3 individually deeded assets that you actually do own. Let's see. How would I get started? So great question as well. Obviously, my contact information is there, as is Brittany's as well. And I'm going to go ahead and put out my scheduler link. That's the easiest way to get a hold of me. You're able to click on that link in the chat box. You get an active look at my calendar, and you can pick out a time that works well for you. When do I typically start seeing income on a purchase I make? How long is the closing process? So since we do all this on the front end before the sale, getting everything set up, we can close in as little as 2 weeks after your account has funded. So if you already have a funded self-directed account, we can close within 2 weeks, but obviously it depends. And this is another good question for Brittany. How long does it typically take to transfer an IRA to an SDIRA account? And is there a penalty if I move from an IRA to an SDIRA account?
So I'll answer the easier part of that question first. There is no penalty if you're transferring from one IRA to another IRA. It is simply a trustee-to-trustee transfer. So not only is it not taxable or anything like that, but it's also not reportable on any tax forms because you're not making a withdrawal from the account. The transfer is taking place between two custodians and you're not touching the funds at all. So you would be able to transfer from whatever type of IRA you hold to a self-directed IRA of whatever type you set up, just assuming that they're, from a tax perspective, they're structured the same way. So you can have a traditional tax-deferred self-directed IRA, a Roth, a SEP if you're self-employed. So there are still different account types within the self-directed IRA world. And then as far as the question about the transfer timeline, it's very difficult. Sometimes it can be difficult to narrow down the timeline for a transfer. And the reason for that is one of the factors out of our control is that you're taking funds out of another account and putting them into a new one that you've created. So the custodian of your current IRA is going to have specific requirements and processing times for releasing those funds out of your account. And we provide a transfer form as part of the account setup process so that you can complete that form and authorize it on our end. And then we essentially send it to that custodian as a formal request. But some of them have different requirements as far as what they need on the form. So we typically can help with that because we have experience working with them over the years. But I would say it can take anywhere from as little as 2 days for a transfer to come through. Or up to a week for a transfer to come through, just depending on different processing times.
Excellent. Thanks, Brittany. I've seen it be really easy, and I've seen it take a long time, and it just feels good when you finally get that money over to your self-directed account, because then you finally have control over it and choosing the right investments. Can I split this investment with another investor? Yes, absolutely you can. We have clients do that all the time. Do most of your clients get approved for that non-recourse financing? Yes, 100% do, since it's not based on your credit and it's strictly asset based. It's only tied to the investment property. And is there, I think we've got time for one more. Is there any particular reason you pick a certain state? Yes, absolutely. We look at macroeconomics first and foremost. We love states that are very pro-business, pro-landlord. States that have no state income tax are a huge bonus as well. And we always look at the population growth of what's going on in the state. And pro-business states tend to have a little bit higher population growth and a little bit more stable economics for what we like to do with passive income producing real estate. Well, thanks so much, everyone, for being on. Thanks so much, Brittany. I appreciate it. If anyone would like to, yeah, we're always a pleasure to have you on our webinars. If anyone would like to, there's a screenshot option at the top of watching the webinar, in addition to my link being there to schedule a follow-up and discuss any further follow-up questions you have. Have a great evening and a great weekend, everyone.
Take care.